please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. The auto cycle appears to be on an uptake, coupled with the fact that monsoons are here. It's going to be a normal monsoon this time around as per the prediction, and all this augurs well for auto financing companies as well as companies exposed to the rural economy like M&M Financial Services. To talk more about the company, we're now joined by Mr. Ramesh Iyer. Good morning and thanks so much for joining in. Auto sales are looking good, monsoons are normal. How have the first 2 months of the fiscal year shaped up for you?
So clearly, even the previous year, quarter over quarter, we had a good quarter moving upward. Last quarter was the best. And as we've seen volumes for this quarter, we continue to see, the dealerships are able to transact large volumes in rural, and we see rural sentiments are very positive. And clearly, the back of expected monsoon to be good, we would believe the sentiments will continue to be positive moving into the festival season. The second half, therefore, is always the best half for rural India, and we expect that would happen.
Okay. Mr. Iyer, good morning. So, you ended off the last financial year with absolutely breathtaking growth numbers on the disbursement side. I mean, you were touching the 40s. Is that kind of momentum going to carry forward in Q1?
So clearly, we don't see too much of competition around the locations that we are operating. We added 100 branches in the fourth quarter last year. That would bring in productivity for us, and we become significant player in pre-owned vehicle, other than pre-owned commercial vehicle, of course, and multiple OEMs reaching out to that market gives us volume. So we very strongly think that with our large network, deeper penetration, relationship with every OEM, we should see no reason why the growth cannot be maintained at this level. And even currently, as we talk, product discounts are continuing, and once we see discounts come off over a period of time for the same volume, the values could be even higher.
Okay, Mr. Iyer, for longest, good morning first. For longest the problem with your company was asset quality, but the last 2 quarters been about improving that consistently. You reckon you are on the right path, and you will continue to improve that?
So I must clarify, the gross NPA definitely is an outcome of customer cash flow, but our credit losses have never really climbed, because ultimately, as the time changes, the customer do pay off their past dues. So we've clearly seen, as the crop cash flow comes in, as we see some infra story unfold in different states, the two cash flows together help the customer, and we believe that the worst is over as far as rural is concerned from where we are, and with expected monsoon to be good, surely we believe that the worst is over.
Have you gained market share in the core passenger vehicle segment, given the kind of numbers you've reported in the prior quarter, and where does it currently stand at?
So clearly we have gained market share for all product, not just cars, but we have gained market share for all product, and as I said, it comes from our deeper penetration, additional branches added, etc. We're also running another program, which is, we have a very large customer base. We've serviced close to 6 million customers in that market, and we are in 330,000 villages where our customers are. So we've launched a program where we reach out to our existing customers, who then help us get more inquiry from that market, and that actually helps us increase our volumes. And currently we are doing about 15–20% of our volumes is self-created by us from that market. And clearly that has put us in a position where we are gaining market share for every product.
Mr. Iyer, sir, slightly macro question. FY19, what will the book really look like? The mix between auto, between SME that you're doing, and within auto, actually I had a question on the lending you're doing to some of the taxi operators, the aggregators, Ola and Uber. Is there any risk to this part of the portfolio?
No, so we don't see that as a risk for a simple reason that it's not concentrated in just one particular city. It's little widespread. We are in Bangalore, Hyderabad, Mumbai, all of these places. And while yes, we are one of the early entrant into this market, and therefore the original, the driver owner whom we have financed have paid off more than 40-50% of their dues. So we don't see that as a risk, while we see that as a volume which is slightly getting stagnated, so the growth from that may not happen as much. But you know, the larger question of how the mix is going to look like, I think we will have about 45% of the book coming from the Mahindra products, which are auto and tractors, within which about 20%, 18 to 20% would be tractor, and 30-32% will be the auto product. We will have cars around 30%, and then we will have construction equipment, commercial vehicle about 8-odd%, pre-owned vehicle will be in the same range of 8-odd%. SME currently is about 6-7%, which will move up to 10% in a growing book.
Yields are going up. Will that hurt the borrowing cost? Can you maintain your net interest margins at the same level?
So clearly we also see the borrowing cost is moving up, but we've always taken a view that either when it comes down or goes up to about 25-30 basis point, we don't really tamper with our lending rates. But if it was to keep moving in that direction, and we see about 50 basis point already moved up or come down, at that stage we pass on the same to customers, and we do think that over a period of time that will get passed on in order to protect the margin. But I think it's also important to understand these are operating costs. People buy vehicle if they feel a need, at least the segment that we operate with, the earn and pay segment, and therefore they will quickly adjust their freight, their per day charges, or the passenger movement cost will all move up if their borrowing cost was to go up. But clearly up to 50 basis point we'll try and manage within, beyond which we would pass on to consumer.
All right, Mr. Iyer, thanks a lot for your time today. It was good talking to you. That's M&M Financials. By the way, just want to point out ICICI Bank just see the chart of ICICI Bank. Sort of made a beautiful low in the opening tick, and after that it's moved on. So once again, because 284, 285 is normally where it sort of bottoms out. In the past, it also done that. And it's a case of how much more will you hurt the stock with the same kind of bad news. So like we discussed in the morning as well, open with a gap down, but as then moving on. This could really be interesting because this is now changing how the bank nifty is shaping up. Almost 100 points higher now on the bank nifty, but the nifty is struggling around the 10,800 to 820. This is zone where because you don't have a news flow, perhaps the market is finding it tough to really break out after that.
Okay, well, on that note, let's move to our next corporate conversation. There have been some very important changes with respect to accounting policies that have to be adopted by real estate companies, and these kick in from the 1st of April this year. Now, a different accounting standard, Ind AS, would be applicable. Companies are expected to switch to the project completion method from the existing percentage of completion method. What does this mean for P&L? How should we evaluate a real estate company in this new environment? Joining us to outline the impact of these changes are Mr. Jaishankar, CMD of Brigade Enterprises, and Adidev Chattopadhyay, who tracks the real estate sector at ICICI Securities. Adidev, morning, and sir, Mr. Jaishankar, morning to you as well. Adidev, I'm going to start with you first and what your broad understanding and analysis is, because it's a fundamental change. Now companies can only start recognizing revenue once a project is complete and not on partial completion milestones. Is this a very big impact? And also, small clarification, will a project be recognized after the OC is granted or the occupancy certificate, or can it be recognized as soon as the actual work is completed?
Yeah, morning. So just to clarify again, the new Ind AS 115 is basically effective from, as you know, 1st April of 2018. That is from FY19 effectively. And it has been brought into place to align with the global IFRS 15, which also follows a similar accounting method. Now, this mainly deals with the subject of revenue from contracts with customers. So real estate also comes under the ambit of this. And as per the definition under Ind AS 115, a developer, that is the interpretation, they can only recognize the revenue when all the when the customer is able to avail the benefits of the unit or the apartment which he has purchased. So the interpretation under this AS is that all developers will now have to shift to the project completion method. Now there are obviously numerous accounting impacts for this, which obviously are optical in nature. The first among these is, from what we understand, like most companies would now have to reverse all the profits they have recognized on their ongoing projects, which are yet to achieve 100% completion, or the interpretation is that only buildings which have received occupation certificate may be certified as 100% complete. So they would have to take a notional hit on their net worth. Otherwise, however, there is no impact on the cash flows of the company. Another complication which is there is now for tax payment. Theoretically, a developer would now pay tax after 4 or 5 years, that is when the project is only complete. But what we understand is that the tax authorities would still like the companies to follow the percentage completion method for tax computation. So basically, developers now potentially have to maintain 2 separate books of accounts, one for the accounting under project completion to comply with Ind AS, and a separate one for the tax authorities as well. So again, these are only optical impacts because as we have seen now over time, over the last few years, now investors have shifted to looking at the cash flows of a company to judge the valuations and the performance of the company, because they also understand there are a lot of accounting complexities which have crept into the sector. So even though, yes, you're right, on a quarterly or on an annual basis, there may be some lot of variance in margins and reported revenue for maybe the next 2 to 3 years. But I think savvy investors would still understand that cash flows remain king in the sector, and we do not see it affecting the valuations of any of the companies under our coverage.
Mr. Jaishankar, good morning. Come in on this. What would be the extent of profit write back for your company based on the revenues that you've already recognized on your ongoing or incomplete projects?
It is a bit too early to say because the impact will be known once the quarterly accounts are finalized. Our auditors, EY, are in the process of calculating the actual impact. The impact can be significant from accounting standards point of view. But as a colleague from ICICI mentioned, the income tax department will still want the developers to pay taxes on percentage completion, and whereas the accounting standards want on total project completion method, this is an unnecessary requirement and an unnecessary disruption to an industry which is still reeling from the impact of disruptions in the last 15 to 18 months. Whether it is the RERA, whether it is the GST and the earlier demonetization. Now, I don't know. And in addition to that, the industry itself is, was on a downward trend for the last 30 months. And it was just beginning to pick up, tempo in the sentiments. And when this comes, again, it can send very wrong signals. The debt equity ratios of listed companies can significantly change because the advances from customer bookings will now be shown as either as loans or as debt as compared to earlier revenue recognition. And this total project completion method was in vogue earlier also, maybe 20 years back. But in the last, sometime end of 90s, the percentage completion method was introduced by the accounting, ICAI, in the Chartered Accountants Association, and which was an accepted practice. Now I really don't see the merit in introducing other than to create another round of disruption.
Okay, that's a big point that you mentioned over there. Let me take that up with Adidev. Adidev, as Mr. Jaishankar pointed out, that advances from customers, they under Ind AS 115 perhaps now need to be shown as debt. That changes a lot with respect to how you analyze the balance sheet. Your thoughts on that one point? And what I asked earlier, is OC required to recognize any revenue? Because then that means further delays. And which are the companies that get hardest hit? Because you mentioned a lot of profit will have to be now written back wherever the project isn't fully complete. Which are the companies which are likely to get hardest hit with respect to P&L changes?
To answer just on the OC point, it is not the occupancy certificate that is required for revenue recognition. It is the registration of the property. Property need to be registered in the hands of the customer.
Sure.
So you may have received occupancy certificate, but if the customer has not opted for registration, then also the revenue cannot be recognized.
Okay, take your point, sir. Thanks for that clarification. I'll be very quickly, little short on time. Just your impact analysis, the companies which are likely to be hardest hit.
Yeah, so we do not see that it is pretty difficult to ascertain a project level profit. As you understand, like even historically, companies have corporate overheads as well. So many projects are on the standalone balance sheet. Some of the projects are at the SPV level, and they again have their corporate overheads. So it is very difficult to ascertain even historically which projects have specifically booked how much profit. And as you understand, in many ongoing projects, few buildings have received completion certificates. Some buildings are yet to receive. So it is still some time away. We'll only come to know once the, once the first quarter results are declared by all these companies, only then will we come to know the impact. Another thing which, if you recollect, which complicates matters now under Ind AS, the definition of effective control. So there are a lot of SPVs where companies are holding more than 50% stake, but under Ind AS definition, they do not show up on the consolidated balance sheet of a company. So again, we do not know what impact, what is the accounting impact or adjustment which these would have. So we would again wait and watch from company to company what is the impact. But again, as we said, this is an optical impact. It does not impact the cash flow of a company. All right, fair enough. Adidev and Mr. Jaishankar, thanks a lot for joining us today. The market is inching up a bit on the bank Nifty, and that's because ICICI Bank has moved up from the low point. On the Nifty, we are somewhere around that 10,800, 810 zone, where last time the market slipped off. Good time to get our technical analysts back, Ashwini Gujral, Mitesh Thakkar and Prakash Kaba with us. Ashwini, so opened flat but has now moved up to the higher end of the recent range. Your thoughts on the index first?
See, I think financials are showing good traction, much better traction than say Nifty or the IT index. So that way, NBFCs, particularly Bajaj Finance, FinServ, also, housing finance, some of the power NBFC. So I think there is still probably shorts which are getting covered from the rate hike type day. But overall, the new high theory is working very well. So Jubilant Food, Titan, Bajaj Finance, all these stocks which are at new highs are moving up even further. So consumption and consumer finance both are looking strong. For the day, Jubilant Food is a buy with a stop of 2680, target of 2760. TVS Motor is a buy with a stop of 580, target of 602. Titan is a buy with a stop of 800, stop of 900, target of 925. And there is a trade on Bank Nifty, but the target is closer to say Thursday's high, say around 680 to 700. So this is a range-bound market. Once you get to the upper end of the range, you need to get off the bus. Otherwise, there are problems. And Canfin Home looks like that's going to have a strong day because some amount of shorts probably are still there in housing finance, and that's probably the last of the NBFCs which need to move up.
Mitesh Thakkar and Prakash Kaba also here with us. Mitesh, any trades that you've spotted in the first 30 minutes of trade so far?
Yeah, see, apart from the fact that, I'd be comfortable going long on the index, despite the fact that we are yet to break about the 10,820 mark, I think the early signs do suggest that the breakout should happen. I think that apart, I have got two buy calls on stock-specific basis. Lupin amongst the pharma names clearly showing good traction on the and follow through on the upside. So buy with a stop at 799, look for targets of 855, and Real Infra is a buy as well. Keep a stop below 437, look for targets close to about 460.
All right, Prakash, how do you read today's opening? Looking strong so far, and of course, trading ideas?
Good morning, Surbi. Yes, the technical targets are 10,857, and today we have seen a new high based on basically the new swing high that we have seen. It's crossed that by a point or two. But the Bank Nifty is a bit too far away, still 200 points shy of the recent high that we have seen. My concern is there. So far, it still looks good to me. I would say 10,857 is the target. And if it goes beyond there, even 10,900 is not ruled out. So there is a good chance that Nifty will go up. Dips can still be bought, and so is the case with Bank Nifty. And if it happens there, then maybe we can see around 26,700 to 26,720 zones. I have two calls here, both on the long side. I'll start with Godrej Industries. That's nearly achieved its target, closer to that. So I would modify the target to 620 zone. So Godrej is 620, target stop below 600 because it's already moved up here. And I also like Nestle. That looks good. We can see a move until 10,140 to 10,150 zones, stop below 9,900. So Nestle and Godrej are two buys.
Okay, fair enough. Well, the stock that's now batting for the bulls is HDFC Bank, and it's now making highs of the morning. So started a bit soft, but is now moving up, and that's of course helping the Bank Nifty as well. Also keep an eye on some of these other pharma names. We've been mentioning Sun Pharma. Dr. Reddy is now moving to the high point. Just pull out the chart of Dr. Reddy's. And even Sun Pharma, for example, it dipped a bit, but look at that move after that, post 9:30 on Sun Pharma, and Dr. Reddy's as well, up about 2.5%. Ashwini, more short covering possible, you reckon, for pharma names? I mean, they were all up 5-6% on Friday, but considering the kind of shorts that exist, you reckon there could be more?
See, my view is that most of the pharma space is bottoming out. And the reason for that is that recent bad news has not led to making of substantial new lows. Most of them are still kind of, hanging around previous lows. So that way, it appears that price action wise, they may have bottomed out. So this is the right time to buy it because incremental news, bad news may not hurt you. So Sun Pharma, Oro Pharma, Dr. Reddy, all of them are showing fairly similar action, and once people realize that they are onto something, I think a bigger short covering will come in, because today you are seeing a clear follow through from Friday's action.
Yes, in fact, I just want to pull out, Ashwini spoke about Canfin Homes. Just see the intraday chart of some of the other NBFC companies where you have some shorts. For example, just pull out a Capital First. That one is making a move now. Shriram Transport Finance is making a bit of a move. Piramal Enterprises, that one also right now making a bit of a move. Of course, you have had Bajaj Finance, which has just kept moving higher. But on the other NBFCs, there was quite a bit of underperformance that you had seen. Ashwani, spotting anything here? You spoke about Canfin Homes, but the others also seeing quite a bit of action now.
See, the way they have reacted to rate hike, which apparently is bad news, shows that, the correction is probably getting done on NBFCs, and you will see higher levels here. So probably much more than the banks, the NBFCs are much stronger buys.
Okay, by the way, 10,820 is here on the Nifty. The mid-caps too are climbing on. So now it's a more than 100-point rally on the mid-cap index, and the advanced decline ratio continues to move in favor of the gaining side. So it's been a steady increase through the start of the trading session as we speak.
Well, yes, the market's got some things going for it for last few days. One, Reliance continuously has been moving up, so that's done well. And today, I think, it's, because you're seeing buying in HDFC Bank at lower levels, and ICICI Bank from the lows has recovered, plus Pharma has done well. So all in all is looking like a good day for now. Let's see, 10,820, I think on closing basis. If you start to move higher than that, then of course it will invite short covering. And also the mid-cap buying is continuing. That advanced decline of 3:1 now is really good, because that's a solid advanced decline that we're looking at this point in time.
Yeah, well, a lot of different boats are being lifted in the mid-cap universe. So the likes of Manpasand Beverages is up about 3% as well. Peninsula Land is rising higher. Lots of stocks on the move on the mid-cap side of the market. But right now, we'll thank all the technical experts. Thank you, gentlemen. We'll keep coming back to you, track this strong market and see if it sustains. Right now, it's time to move forward and get you our promised stock analysis, the special series called Hunting for Value. This is a large stock that we are talking about, but it has also been beaten black and blue over the last couple of months. Is there value? Let's look at what's on Abhishek's radar.
Well, Surbhi, to begin with, we are talking about Punjab National Bank. The stock is down about 49% in 2018, while it is down about 62% from its 52-week high that it made on 26th October 2017. Now, why the fall? The key question is that the 2 billion plus Nirav Modi fraud led to the trigger of the decline in stock price, and that also led to the worst ever performance from PNB, wherein it reported the highest ever quarterly loss loss that was largely led by due to deterioration in asset quality, highest ever quarterly slippages and the gross NPA. This, along with lower capitalization, actually led to the street talking about the possibility of the bank going into prompt corrective action of RBI, which can make many restraints if it had fallen. So what are the triggers for the reversal? Now the government is talking about 12 to 13,000 crore of rupees to be generated by PNB in H1 FY19. That is through sale of non-core assets, subsidiary stake sale, NPA resolution. So PNB on Friday had actually announced that they are looking to pare down their stake, especially in PNB Housing, wherein they hold 33%, which as on yesterday's closing price actually values at 6,200 crore plus, and in ICRA, CRISIL and BSE. They are also looking to sell down their Bikaji Kama headquarter for 1,300 crores. The deal is almost finalized, and also the resolution in LCLT cases, just like Bhushan Steel, for example, which will lead to a 900 crore reversal and which will lead to higher profitability. Government will also look to infuse money in various tranches. Most of the stress, as per the management, has been recognized. And if you look at the presentation, the incremental stress on the balance sheet is on the lower side. Now, mixed review are coming in from brokerages, wherein Morgan Stanley is bullish. Kotak Securities feel that the current market price is fair valuation, while Nomura is bearish on the bank. So Morgan Stanley has a target price of 125. Kotak has a target price of rupees 90. But interestingly, Kotak mentions that, expect strong recovery and upgrades for a few quarters, and medium-term outlook looks less uncertain. Nomura has a target price of 75 with a reduced rating. If you look at the peer comparison, the valuation for PNB, if you look at the average valuation of the top 5 PSU bank, is down about 14% on an average basis for FY19 and about 12% on an FY20 basis. A disclaimer, this is not a stock recommendation, but just a quick highlight as to why the stock has taken a beating and what can revive.
Okay, Abhishek, thanks a lot for that. That standard disclaimer is most important. And frankly speaking, I mean, if you are buying PNB at these prices, or at any prices for that matter, that's the call that you're taking, that it's a double or nothing. I mean, really, the stocks trade at valuations for a reason, and market gives them, valuation for a reason. Market gives HDFC Bank a valuation, and market gives PSU Bank a valuation for a reason. Sanjeev Bhasin of IIFL now joins us on the phone line. Sanjeev, good morning. Your thoughts on PSU banks and PNB in particular?
Yeah, so Anuj, it's a glass half full or half empty. I think a lot of the pain and the downsizing of asset quality is over. But if you heard what the State Bank chairman told you, I think we've turned very bullish after the State Bank results. So we've had a basket of stocks, namely State Bank, Indian Bank, PNB at 78, 80, where we've been very, very bullish. Just to tell you, PNB trades at a market cap of 25,000 against HDFC's 5.5 lakh crore. So I think this must be the steepest discount we've seen on a PSU bank, which is the second largest in the country. And we think the glass is half or maybe 3/4 full as far as the bad news. The positive is that the bank has indicated that they are going to reduce non-core assets, bring back cash on the balance sheet, and there is a whole revamp. Only time will tell how it plays out, but we think that going forward, as we see more pickup in corporate credit and their focus on retail, we think PNB can give you a 30% upside in the medium to short term.
30% upside, Sanjeev. Sure, I mean, when it turns, it turns. The question is perhaps when and how. In the next 2-3 quarters, let's talk about the medium term, the near future. Are you looking at significant, perhaps, write-backs from some of these NCLT cases? We might not see more bad loans, so there's a bottoming out there. But what is the first positive that you are looking at?
So two things. If you saw, Bhushan Steel was being bid for 18,000 and 36,000 has already come into the bank's accounts. You've seen the same with Electro Steel. You've seen the same with Bhushan Cement. Firstly, the asset cycle is on a very, very strong uptick. And I think that I'd be surprised if there may be more write-backs than write-downs going forward. Secondly, you've heard from the new finance minister or the temporary one who said ARC and bad bank. All that means that the color would be very, very positive if you had one of those implementations. Third would all be depending on how the recapitalization gets a foot forward. So, these are three tantamount decisions, but we think that aside from the capex expansion on the government side, I think private capex is now reviving. Whether it's NBFCs, it's consumer credit, it's manufacturing. And, you know, sooner rather than later, we would start to see their books also expand on that as the bad loans reduce and, you know, as we see more improvement in asset quality. So I don't rule out that by the end of the year, at least a 30% upside in mainly PNB.
So Sanjeev, the recovery numbers spoken about for PNB, 8,000 crore by Q1, perhaps 12 to 13,000 by 12 to 13,000 crore by Q2. They look realistic, according to you.
Definitely. Look at the capex, look at the asset cycles, whether it's steel, it's power, it's infrastructure. You are all seeing a huge leg up over there, aside from manufacturing. You know, steel itself was one of, PNB has one, would be in the top 3 on the exposure they had. And I mean, look at the prices and you're aware that what the steel cycle and a lot of the other commodities are going through. Secondly, NCLT is a very, very powerful tool. You may have seen 3-4 cases, but the implementation of the rest is now on the card. So I think definitely there is a reinforcement of confidence, and bankers would now be much more in a easier space after this whole, you know, has played out on the negative side.
Okay, all right, Sanjeev, we'll leave it on that note. Thanks very much for joining us and giving us your ideas on PNBs. That's a positive view, playing for a 30% upside there, as per Sanjeev. This market's looking very, very strong. 10,830 has come very quickly. You're looking at a 60-point rally now on the index. Mid-caps are running away as well. And along with some of the other financial names, PSU banks actually are doing well. State Bank of India also reaching the day's high. It's a green screen today. We'll take a very quick break. On the other side, DK Hota, chairman of BEML, joins in.